Hey, how's it going, everyone? This is Mark McInerney with Code Mark Financial. Trust everybody had a happy Thanksgiving. It's nice that the weather's gotten cooler now as well. Let's move forward. As I told you, I'd kind of break into a series of what one needs to purchase a house and how to qualify for a loan. Part one, if you want to revisit it, I talked about the very preliminary things a buyer needs before even getting to a mortgage person, such as the earnest money, money for an inspection, and even having money ready for the appraisal, which would come when you come to us. But to get right to it, once you get ready to get pre-qualified for a house, there are going to be three things that a lender is going to look for. Okay, one is your credit score, two is your debt to income ratios, and then three, down payment money. Okay, now for example purposes, I'm going to use kind of very round numbers here, but one thing that is pretty ironclad is in today's market, as far as credit scores, speaking on that one first, you need a minimum credit score of 640 in order to qualify for a loan. Okay, now as many of you know, there's three credit bureaus out there. None of them score the same. One usually scores high, one scores low, and then there's one in the middle. It's that middle score that the lenders are going to be looking for to be a 640. Secondly, debt to income ratios. Now this is a little tricky, but in layman's terms, the basics of all of this is that your outgoing debt, including the proposed mortgage payment that you're going to acquire. So if you're looking to buy, a house and your mortgage payment is going to be $1,500, that number is going to be included into this debt to income ratio formula that I'm going to explain. But the basics of it is that your current debt plus the new mortgage payment that you're trying to qualify for cannot exceed 45% of what you make every month. Okay? Now that's not net. That would be off of your gross monthly income. And then now the last thing then, of course, is going to be down payment. Now, as it stands right now, the loan program with the easiest requirements as far as down payment amounts are concerned is an FHA loan. An FHA loan only requires 3.5% to be put down of whatever the sales price is. So on a $100,000 house, you would need to have $3,500 as far as what your down payment would be. So those are the three things: minimum credit score of 640. Your debt to income ratios, again, just for loose figures, cannot exceed 45% of what you make every month, and that is to also include the proposed mortgage payment that you're trying to qualify for. And then number three is going to be the down payment amount of 3.5%. Now, in part three, this is part two, in part three of breaking down this entire process of buying a house and then qualifying for a loan, I'm going to break down each of these individually. We'll talk about in part three credit scores, what to kind of expect on how to be able to increase your credit scores, so on and so forth. Part four, we'll talk about the debt to income ratios. If you make X amount of dollars, how much house can you buy, so on and so forth. And then in part five, we'll talk about down payment amount. It's very possible by the time that I get to part five, it'll be into the new year, and it might be even subject that a lot of what I'm telling you is subject to change. I should probably disclose that now, because in my business, quite honestly, things change on a daily basis. But as it stands right now, this is the case. So anyway, give us a call if you have any questions. You can always reach me, Mark McInerney, at 832-677-7678. You can reach myself or my business partner, Cody Davison, at our office, 713-974-8846. Otherwise, if I don't kind of talk to you guys then, have happy holidays and happy new year, and then we'll see you on the flip side of 2011. Mark McInerney with Code Mark Financial. Thanks a lot.